we did have someone recommend the banks, and Andrew's right. They have been out of favor, but I've seen some people come on here and say, this is the time because all the bad news is out and interest rates are as low as they're ever going to be. And this is the time when you build a position based on price to book and all these different things. So I actually have heard people recommending banks. Are you recommending banks?
We are, but you got to take the timing of when it's going to be, like you said, the right time. Banks are a trade built on, are we going into recession or not into recession? Andrew, when you talked about banks have been out of favor, the reason they've been out of favor is after the tax reform, and since then, it's all been about the inversion of the yield curve and are we going into this recession? And the probability, at least what people talk about it, you hear them on here, the probability has been going up. In relation to the earnings growth that we just saw on those numbers, down 3%, if you look at the banks in general, year over year, they're going to be up 2%. Now, we parse that out a little bit more. Money center banks are going to be down 1%, and the super regional banks are going to be up 6%. So you're seeing the momentum that we're being able to see really come from the super regional banks, and we think that eventually that's going to be your best play valuation-wise and also momentum-wise.
What should we be looking for, and what are the biggest, which reports? I mean, within the reports, what are we looking for, and who are you? Who will be most indicative of the health of the sector this week?
So there's two pieces of that question, and they're very important. If you look at what you're looking for, the recession question is on two axes of earnings for the banks. One is net interest margin, so what happens with interest rates? And the second piece of it is what are we doing as we're looking at credit? What we continue to see and why the banks perform better every quarter on earnings season, stock-wise, is that credit hasn't risen its head. There's no deterioration in credit as we're going through this process. If there continues to be no deterioration, that pushes that recession expectation off into the future. What we have seen is that the inversion of the yield curve and the drop in rates has impacted net interest margins. So while we hadn't seen that charge-offs go up, net interest margins are starting to come down. So we are going to see that negative impact. So what we want to see is which banks can fight that net interest margin compression, and that's Regions and Fifth Third. So if we can see those two banks talk about, at least going forward, how they're being able to restructure the balance sheets and be able to defend their net interest margin, then you can have both of those elements working in their favor.
What do these latest moves by the Fed mean for any of this, if anything?
What it means is,
what does it mean?
Well, it matters because when you go through this, now this is where it gets a little complex. We talk about Wilfred and I getting into the metrics.
And look at you smiling.
Yes, it is.
It's so excited. He's just like the moment. The moment is here.
So weird.
This is the Super Bowl. He gets it 4 times a year.
Yeah, that's right. So this is the point. This quarter, we're going to see net interest margins compress more because when we went from rising interest rates to declining interest rates, there wasn't much you could do with deposit betas. So in other words, your deposit pricing was frozen. Your asset yields, when the Fed reduces rates, asset yields go down. Right. If you can't change your funding cost, there's going to be a lot of compression. However, as we've gone through the second and third eventual cut, what we'll see is that those deposit rates will start to come down. That'll be a benefit for the margins that we're not seeing in this particular quarter.
Got it. Well, what's interesting, and what I'm going to glean from all this is if we see some disappointing numbers and the bank stocks go down and people start saying, see, a recession is coming, you really need to look into where the weakness lies. If it's not credit weakness and it's net interest weakness, then you shouldn't automatically assume that it's indicating that there's a recession that's imminent. It just means that it's a flat yield curve.
That's exactly right.
So we need to watch for credit. Credit is going to be the canary in the coal mine for whether recession forecast should go up, probability.
And bank valuations.
And bank valuation.
Both, because if you don't get credit, in other words, we can have some compression in interest margin. The impact on the bottom line and returns is it's pretty manageable. We can maintain or sustain returns at this level, which valuations don't reflect that, right, Andrew?
Right.
So if you maintain or sustain your returns, the price of tangible book value, which is now 165, which is really supported by recessionary levels, dividend yields, cash returns, things like that. But if we actually sustain the returns, the valuations have to go up towards 2 times tangible book value if we're not going to see that recession.